Good morning, everybody. Thank you for joining me for today's webinar. My name is Amber Hines, and I'm the owner of Ashbur. We today are going to be talking about planning for married couples with annuities and when each spouse may consider purchasing an annuity in each of their names. If you're interested in the handouts from today's webinar, feel free to download those from the handouts tab of the GoToWebinar dashboard. And also, if you have any questions during today's program, feel free to type those into the questions tab of the GoToWebinar dashboard as well. Again, my name is Amber Hines. My maiden name is Gwynn. Some of you may know me by my maiden name, but I've been working with elder law and estate planning attorneys for the last 15 years to help their clients secure Medicaid eligibility by using Medicaid compliant annuities. I am insurance licensed in all states, and I hold a Series 65 license with FINRA as well. I created Ashbur to assist advisors and attorneys with pre-planning solutions as well as crisis Medicaid planning solutions as well. How we can help you and your clients is that we offer complimentary case analysis. So we will help you to determine the appropriate amount to go into an annuity, the appropriate term for the annuity, as well as which assets your clients may consider annuitizing. If your clients have money that is currently in IRAs or non-qualified annuities and you're looking to convert those into Medicaid compliant contracts, we can assist with that process, with the funding process, and doing the actual transfer of funds. We do work with A-rated insurance carriers. Some of the carriers that we work with are able to do very short-term annuity contracts as short as a 2-month time frame. And we'll be talking more about when that might be advantageous for some of your clients. We offer top-notch customer service. If you contact us with a scenario or give us a call, we typically are able to get back to you within a 24-hour time frame, and we're very responsive. So again, today we're going to be talking specifically about crisis planning, about Medicaid planning for your clients that are married. The planning goals when we have a Medicaid crisis case is to convert what Medicaid is going to consider to be countable resources or liquid assets into non-countable or exempt resources, and we want to do this in the most cost-effective, tax-efficient way. So we're going to look at the assets of the client, and if we determine that it's going to be a huge tax burden for the client to liquidate certain accounts or to change ownership on certain accounts, then we're going to take that client's life expectancy into consideration before we would implement any type of plan that is going to result in a lot of tax consequences being paid by the client. The second objective when we are doing Medicaid crisis planning is to minimize or avoid estate recovery. In the situation of a married couple, we of course are going to have asset and income limitations for the couple that is looking to qualify for Medicaid. When it comes to the income limitations, generally the institutionalized individual or the potential Medicaid applicant, their total income must be less than the cost of care, with the exception of states that impose an income cap. And if you're in an income cap state, then you would need to establish a qualified income trust or a Miller trust if the Medicaid applicant's income exceeds around $2,400 a month. Then their income would have to flow through that Miller trust in order to establish that the Medicaid applicant has income that is less than what the income cap is. It's generally not that hard to achieve the income limitation for an institutionalized person because the cost of care can range anywhere from $4,500 a month up to $20,000 a month, depending on the state that we're planning in. When it comes to the community spouse or the non-Medicaid applicant, In almost all states, the community spouse can have unlimited monthly income without having to contribute any of the community spouse's income towards the Medicaid applicant's cost of care. When we look at the asset limitation for a married couple, the institutionalized spouse or the Medicaid applicant, the spouse that is actually in a nursing home and is trying to qualify for Medicaid, they generally cannot have more than $2,000 of liquid resources in their name. And if you're in a state that considers retirement accounts or IRAs as accountable resource, then that $2,000 asset limitation is going to apply to those retirement accounts as well. Also, when we're looking at a community spouse or the spouse that is residing at home that is not applying for Medicaid, they generally are able to keep around 1/2 of the couple's total countable resources up to a limitation of $130,380 in total liquid assets. Some of the other resources that are going to be protected under the Medicaid rules when we're looking at a married couple, the community spouse is going to be able to remain in the home and have the home not be considered accountable asset. They can have one vehicle or automobile that they would use for transportation. Also, they are able to keep the household goods and personal property. They can have an irrevocable funeral trust or prepaid burial plan. And then in some states, the retirement account or the IRA is going to be considered an exempt asset. If your Medicaid clients do have excess resources, we're generally going to look at developing a Medicaid eligibility plan. This is going to include improving or increasing the non-countable assets. So if there is a small spend down amount, say $10,000 or so, and the home needs some improvements, they need a new kitchen or need remodels done to the bathroom, we can achieve the spend down pretty easy by making improvements to the home or having the couple purchase a new car with the small spend down amount. Also, we can look at purchasing prepaid burial policies or irrevocable funeral trusts. They can pay off credit cards, mortgages, or other debt that they have. And then once they have looked at all of these other options for spend down, if there is still money that is left over, the couple can consider purchasing a Medicaid compliant annuity that would comply with the Deficit Reduction Act of 2005. When we look at Medicaid planning with annuities, Medicaid compliant annuity is always going to be a single premium immediate annuity. It's never a tax deferred annuity. A tax deferred annuity is going to be an asset for Medicaid qualification purposes because there is a surrender value or a liquid value that the client is able to access. So a SPIA is going to be a contract that is issued by an insurance company and it's used to convert excess countable assets into an income stream. Once a SPIA is purchased, that income stream is going to be considered irrevocable, is no longer an asset, is strictly income that the client is able to access, usually on a monthly basis. As a result of the Deficit Reduction Act of 2005, immediate annuities that are used in Medicaid planning must meet very strict requirements. So it's not a contract that can just be purchased from XYZ insurance company that issues immediate annuities. It needs to be a company that actually offers a Medicaid compliant contract, and we're going to be talking about the language that must be contained within the annuity contract in order for it to be considered Medicaid compliant. There are hundreds of insurance companies out there that offer immediate annuities that convert a resource into an income stream, but there's less than 10 insurance companies out there that offer a Medicaid compliant contract. The language that must be contained within a Medicaid compliant annuity is listed on your screen. The first requirement is that the annuity must be completely irrevocable, meaning that we can't change any aspect of the contract after it is issued. It cannot be that the income stream is strictly irrevocable. We must have a contract that we can't change the payee, the owner, the beneficiary, the payment date, or any aspect of the contract once it is purchased. The second requirement is that the annuity must be non-assignable. Being non-assignable is achieved by having a contract that a company like J.G. Wentworth or Peachtree would not offer the client cash to purchase the contract. The third requirement is that the annuity must make equal payments without any balloon payments at the end of the contract. The fourth requirement is that the annuity must be actuarially sound. This means that the annuity must be structured with a time frame that is going to pay out within the client's Medicaid life expectancy. Some states are going to use their own state-specific life expectancy tables, but the majority of states use a Social Security Administration table, which tells us what the maximum life expectancy is of the client, but we can always shorten the annuity time frame in order to accelerate how quickly the client is going to receive the payments back from the annuity. The final requirement is that the state Medicaid agency must be listed as a beneficiary. There are some exceptions to the state being listed as a beneficiary, but in most cases, they are going to be in the first position when the annuity is purchased if the annuity owner were to predecease the term. The different types of assets that can be used to purchase a Medicaid compliant annuity, it's really any type of liquid asset that your client has. If they have money that's in checking, savings, CDs, bonds, stocks, brokerage accounts, whole life insurance policies, non-qualified annuities or IRAs, retirement accounts, 403Bs, things of that nature. Any of those types of assets can be used to purchase a Medicaid compliant contract. If you do have clients that have stocks, bonds, brokerage accounts, those accounts will need to be liquidated first to a cash position to then purchase the annuity. We can't do an in-kind transfer of those types of assets to a Medicaid compliant contract. If your clients have money that is in whole life insurance policies or non-qualified annuities, we can do a 1035 tax-free exchange of those types of assets into a Medicaid compliant annuity. And that really comes down to whether there's a lot of deferred gain or interest in those types of contracts as to whether it makes sense to use a 1035 exchange or to simply liquidate those accounts and purchase a Medicaid compliant contract. And then finally, if your clients have IRAs or other types of retirement accounts, SEP IRAs, 403Bs, 401Ks, we can do a direct transfer of those types of accounts into a Medicaid compliant annuity that would be purchased with pre-tax dollars. Ownership from husband to wife or vice versa of any of these assets can be changed quite easily with the exception of IRAs or other retirement accounts. We're unable to change ownership of a retirement account without triggering immediate tax consequences to the owner of the retirement account. And the reason being is that those accounts have never been taxed before. And so any of the pre-tax retirement accounts or IRAs, we're going to have a challenge if the owner of that account is also the person that is trying to achieve Medicaid eligibility. First, we're going to be looking at a traditional community spouse annuity plan with non-IRA funds. In this scenario, we're going to be reviewing a situation where we have one spouse that is in a nursing home and the other spouse is remaining in the community or at home, and we are dealing with all after-tax or non-retirement funds. The goals when we are planning for a married couple is that we obviously are trying to achieve Medicaid eligibility without any kind of private pay period for the institutionalized spouse, and we're doing that by converting excess resources into an income stream. The second goal is to provide the community spouse with peace of mind as well as sufficient income and resources in order for them to maintain his or her lifestyle within the community. So our married couple scenario is dealing with Roger and Nancy. Roger is 80 years of age. He has dementia, has been residing in a nursing home for a while, and has monthly income of $2,000 per month. His nursing home is costing him $10,000 per month. And Nancy is the spouse that is residing at home. She's considered to be the community spouse. She is 75 years of age and has monthly income of $1,000 per month. The couple has a home, a car, and $300,000 of non-IRA bank accounts. If the couple does nothing, with them spending around $10,000 per month on Roger's care, they're going to exhaust their life savings within a 30-month time frame. When Roger passes away, Nancy will be left with limited assets and nominal monthly income. So what we're going to do is first calculate the spend down amount, or the amount of excess resources that this couple has. Roger, as the Medicaid applicant or the institutionalized spouse, he is allowed to keep his personal property, a prepaid funeral policy, and $2,000 of the $300,000 in cash assets. Nancy, as the community spouse, is able to keep the home, car, personal property, a prepaid funeral policy, and $130,380 of the $300,000. When we add the $130,380 plus the $2,000 that Roger is able to keep, we know that their total exempt or protected assets are $132,380. And when we subtract that from the $300,000 of cash assets that they have, we see that they have a spend down amount of $167,620. In order to eliminate the excess resources or the spend down amount, we can purchase a post-tax Medicaid compliant annuity for Nancy. Nancy would be the annuity owner, the annuitant, and the payee. We would structure the annuity over, in this example, 157 months. This is based on Nancy being 75 years of age, and with her life expectancy being just over 13 years, 157 months is the longest annuity term that we could purchase for her. But we could also look at shortening this time frame as well. Knowing that an annuity can only be structured for a whole number of months, 157 months would be the longest time frame that we could do, even though her life expectancy is 157.2 months. We can't do that full time frame, so we would look at 157 months for the annuity period certain. The monthly payment from the annuity is going to be $1,100 each month for a total payout of $172,700. The total payout is slightly greater than the amount going into the annuity, just based on the interest that the insurance company would pay back to Nancy for investing this money over the 157-month time frame. The parties to the community spouse annuity are going to have Nancy be the annuity owner, the annuitant, and the payee. The primary beneficiary in most cases, in most states, is going to be the state Medicaid department, to the extent that Medicaid benefits are provided on behalf of Roger. There's an asterisk there because there are a few exceptions to the state being named as the primary beneficiary. If the couple does have a minor or disabled child, they can be listed before the state Medicaid agency. And then there are some states also that will allow for the institutionalized spouse to be listed as a primary beneficiary before the state Medicaid agency as well. The contingent or secondary beneficiary after the state is going to be the couple's children, a trust, a charity, or really whoever the couple wants to name to receive the remaining annuity amount if the community spouse, Nancy, were to pass away. We a lot of times get the question of why Nancy is the individual or the spouse, in this case that would be purchasing the annuity, and why Roger is not the owner of the annuity. Medicaid does not impose any kind of transfer penalties or penalty periods for transferring assets between the spouses, and the community spouse can have unlimited monthly income without having to contribute their income towards the institutionalized spouse's cost of care. So if the annuity was purchased in Roger's name instead of Nancy's name, then part of that income is likely going to go towards Roger's cost of care if he was going to be the owner of the annuity contract. If the income from the institutionalized spouse is not transferred over to the community spouse under the monthly maintenance needs allowance calculation, then the annuity income is going to go towards the institutionalized spouse's cost of care or their patient liability. And I should mention that the monthly maintenance needs allowance is the minimum amount of income that the community spouse is entitled to. If the community spouse does not have enough of his or her own monthly income, then they're going to receive some of the institutionalized spouse's income to get them up to the minimum amount of income that they're entitled to. The income calculations in this case, after purchasing the annuity in Nancy's name, we would have to add her Social Security income of $1,000 per month to her annuity income that we generated over 157 months of $1,100 per month. And the total amount of her income now is at $2,100 each month. We're assuming in this case that Nancy has a monthly maintenance needs allowance of $2,178. So she is $78 short of meeting her minimum amount of income that she is entitled to. So she's actually going to receive some of Roger's monthly income, $78 per month from Roger, to bring her up to the $2,178 that she would be entitled to. When we're calculating Roger's copay amount to the facility, we're going to take his Social Security income of $2,000, subtract out the amount of income, the $78 that is shifted to Nancy, and then also subtract out his personal needs allowance of $50 each month to determine that his copay to the facility is going to be $1,872 each month. The economic results that we were able to achieve for this couple by purchasing the annuity for Nancy was that they were expected to pay $10,000 per month for his care. We were able to reduce his copay down to $1,872, and the couple experienced a monthly savings of $81.28 each month. The advantages of the annuity plan is that we were able to achieve immediate Medicaid eligibility for Roger. without any kind of private pay or penalty period. And we also were able to create sufficient monthly income for Nancy by purchasing the annuity so that she can continue to live in the community. The potential disadvantage would be that with the state Medicaid agency being the primary beneficiary of Nancy's annuity, if she were to predecease the term of the 157-month contract, the state would be entitled to recover the amount that they provided on behalf of Roger. And a lot of times, in order to reduce the likelihood that the state would have a right to recover against the annuity, we would look at shortening the annuity term to something less than 157 months or the full life expectancy of the client. The impact on the annuity when each spouse passes away, since Nancy is the annuity owner and the annuitant in this first case, Roger passing away really is not going to have any impact on the annuity contract at all. It's not going to trigger the beneficiary designation because Nancy is the owner and the annuitant. But if Nancy were to pass away during the time frame of the annuity, the Medicaid department would be the primary beneficiary in most cases. They would get paid back for the amount that they provided on behalf of Roger, and then the secondary or contingent beneficiaries would receive the amount that is remaining. The timing or the steps to secure Medicaid eligibility through the use of an annuity. First, we want to establish the snapshot date or the date that Medicaid is going to look at the total resources of the client. So generally, one spouse is going to enter a facility first. We're then going to determine the spend down amount or the excess resource amount. We purchase the annuity with the spend down amount, and then once the annuity is purchased, a Medicaid application would be completed and submitted in order to start the Medicaid eligibility process and to secure eligibility for Nancy in this case. The first case study is going to apply when the majority of the couple's countable assets are invested in after-tax or non-qualified funds, money that is in checking, savings, CDs, and there's going to be limited tax consequences for transferring assets from the institutionalized person to the community spouse. Also, the couple would be seeking immediate Medicaid eligibility in the first scenario. If we consider a fact change and we consider a case where an institutionalized spouse owns an IRA, in the original example, the community spouse or the couple had a spend down amount of $167,620, and it was consisting of all non-IRA accounts. So Nancy was the owner of the non-qualified or post-tax dollar Medicaid compliant annuity. But if we consider a situation where part of that spend down amount of $167,000 is in Roger's qualified retirement account or an IRA, and we consider that $100,000 of the spend down amount is owned by the institutionalized person, the real problem asset in this second scenario is Roger's qualified account, because we can't change ownership of Roger's IRA over to Nancy without the owner incurring immediate income taxation. You're seeing a map on the screen now that all of the states that are in white are states that consider the institutionalized spouse or the Medicaid applicant's retirement accounts to be countable resources, whereas the states that are in orange are states that consider the institutionalized spouse or the Medicaid applicant's qualified account to be an exempt resource, either completely exempt or exempt if the Medicaid applicant is receiving their required minimum distribution for IRS purposes. So obviously, most of the states that are on the screen here are ones that do consider the Medicaid applicant's retirement account to be a countable resource. And so looking at the different options for a retirement account that is owned by the Medicaid applicant is going to make sense in any of these states that are not in orange. The options that we have when the Medicaid applicant owns a retirement account, there's going to be 3 different options that we're going to talk about today. The first option is to liquidate the Medicaid applicant's IRA, pay the taxes, and purchase an after-tax or non-qualified annuity that would be owned by the community spouse. Essentially, the couple is going to pay all of the taxes up front to get after-tax monies over to the community spouse so that they can purchase an annuity like we talked about in the first scenario. The second option would be to transfer or roll over the IRA into an IRA Medicaid compliant annuity that would be owned by the institutionalized person, and they are also going to be the payee of the Medicaid compliant annuity. The third option is to use name on the check rule, and this is going to involve transferring or rolling over the Medicaid applicant's IRA to purchase an IRA Medicaid compliant annuity that's owned by the Medicaid applicant, and the payee is going to be the community spouse. Option 1 is going to be that a non-qualified Medicaid compliant annuity is purchased by the community spouse. So we would be looking at liquidating Roger's IRA, paying the taxes, and after the taxes are paid, all of the money then is non-qualified or post-tax funds. So we'll assume that 22% tax is paid on the $100,000 IRA. After paying $22,000 in taxes on the $100,000 IRA, we would have around $78,000 net that we would be able to shift over to Nancy to purchase a non-qualified or a post-tax dollar annuity. By paying the taxes up front, the couple is going to lose around $22,000 immediately by paying that tax bill. And after Roger liquidates the IRA, pays the taxes, now all of the couple's assets are going to be considered post-tax dollars. Nancy can now purchase one non-qualified Medicaid compliant annuity. This is going to be similar to the first scenario that we talked about. Nancy's after-tax Medicaid compliant annuity would be funded with a total of $145,620. This is really taking the amount in the first example and subtracting out $22,000 that would be paid in tax, so that we would net around $145,620 that would then be used to purchase a non-qualified annuity for Nancy. Her annuity could be structured for the full life expectancy of 157 months, or obviously we can look at shortening that time frame as well in order to decrease the likelihood that she's going to predecease the term of the annuity contract. We're going to eliminate the excess resources the same way that we did in the first example. We're going to put $145,620 into a non-qualified or a post-tax dollar annuity, Medicaid compliant annuity. Nancy's going to be the annuity owner, annuitant, and payee. You'll see that instead of the annuity generating around $1,100 per month in income, it's now going to generate $950 per month because there's a lesser amount that's going into the annuity in the second example because we paid the taxes up front. The parties to the annuity contract are going to be exactly the same as our first scenario because we're again using all after-tax dollars. Nancy is going to be the annuity owner, annuitant, and payee. The state's going to be the primary beneficiary for the amount that they provide in Medicaid benefits on behalf of Roger, and then the children, a trust, or a charity, whoever they want to name as a contingent beneficiary would be listed on the annuity application. The income calculations in the second scenario include Nancy's income from Social Security of $1,000 per month plus her annuity, which instead of paying $1,100 per month is now paying $950. Her total income is $1,950 in this case. So she actually has a greater income shortfall from being able to meet her monthly maintenance needs allowance of $2,178. She is going to receive more of Roger's income in this second scenario because her income is less. So Roger's copay to the facility is going to be his $2,000 from Social Security less the $228 that he's going to be able to shift over to Nancy, and then also subtracting out $50 for his personal needs allowance, and we determined that his copay to the facility is $1,722. The economic results of option number one is that we were able to reduce the copay down to $1,722 when the couple was originally expected to pay $10,000 per month. So the monthly savings each month is going to be $82.78 that the couple was able to save. The advantages of option number one, basically liquidating the IRA, paying the taxes, and shifting the net amount over to the community spouse, is that it's a safe option. We know that Medicaid will accept this strategy in all states. Roger is immediately eligible for Medicaid by purchasing the annuity in Nancy's name. And Nancy is still going to receive a portion of Roger's monthly income through the monthly maintenance needs allowance calculation because she did not have sufficient income on her end to meet the minimum monthly maintenance needs allowance. The disadvantages of option number one include paying the $22,000 in taxes up front. So in a lot of these cases, we have to consider the size of the IRA account that's owned by the Medicaid applicant and also what their life expectancy is. We don't want to incur $100,000 of tax consequences to liquidate a retirement account and then have the Medicaid applicant only live for a couple of months, which ultimately means that Medicaid is only covering the bill for a very short period of time. So if we have somebody that has a very large IRA in the name of the Medicaid applicant and we don't anticipate them living for a long period of time, it may not make sense to pay all the taxes up front in order to achieve Medicaid eligibility. If we are putting a large portion of the couple's income through the taxation system, this may result in their Social Security benefits becoming taxable, and it may also increase their Medicare premiums as well if we are increasing their taxable income by liquidating the IRA and shifting that money over to the community spouse. The second option, when we have a IRA or retirement account owned by the Medicaid applicant, would be to use an IRA Medicaid compliant annuity that's owned by the institutionalized person, and they are also going to be the payee of the Medicaid compliant annuity. Instead of liquidating Roger's $100,000 IRA account and paying all the taxes up front, we could use the $100,000 that is in Roger's IRA to purchase an IRA Medicaid compliant annuity that would be structured over his Medicaid life expectancy. By purchasing the IRA Medicaid compliant annuity, we are meeting the $2,000 asset limitation by converting that $100,000 IRA into an income stream and purchasing the annuity in Roger's name. Roger, since it's his IRA account, we would have to purchase an annuity that is also owned by Roger, and we would purchase the $100,000 IRA Medicaid compliant annuity by doing either a direct IRA transfer or a 60-day rollover of the $100,000 IRA in order to purchase the IRA Medicaid compliant annuity. Since we can mix post-tax dollars and pre-tax dollars into the same annuity contract, we would have to purchase a second annuity for Nancy that is going to consist of the $67,620 that is remaining as the spend down amount. So the chart on the screen is showing you that Roger is going to own the $100,000 IRA Medicaid compliant annuity. He's also going to be the payee of this annuity contract, and it's going to generate $1,050 per month of income to Roger. His Medicaid life expectancy, based on him being 80 years of age, is 8.43 years, or 101 months is going to be the longest time frame that we would usually look at for doing this annuity for Roger. Nancy is going to be the owner and the payee of a second post-tax dollar Medicaid compliant annuity that is structured with $67,620. This is going to be structured over Nancy's life expectancy of 157 months, and this is going to generate $500 a month of additional income for Nancy, since she is the payee of this second post-tax dollar annuity. The parties on Roger's IRA Medicaid compliant annuity is going to be that Roger is the annuity owner, annuitant, and payee. Nancy, as the community spouse, would be entitled to be the primary beneficiary before the state Medicaid agency. And then if the couple wants to name a tertiary beneficiary, they could name the children, a trust, a charity, or whoever they would like to name as the tertiary beneficiary after the state Medicaid agency. On Nancy's non-IRA annuity, she's going to be the owner, annuitant, and payee. The state is still going to be the primary beneficiary to the extent that they provide benefits on behalf of Roger, and the secondary or contingent beneficiary on her annuity is going to remain the children, a trust, a charity, or whoever they want to name. The financial impact of Roger purchasing the IRA Medicaid compliant annuity and Nancy purchasing a non-IRA Medicaid compliant annuity is that we increased Roger's monthly income from him only receiving Social Security of $2,000 up to $3,050 per month, and that is determined by adding that annuity income of $1,050 each month to his Social Security at $2,000. Nancy's monthly income is also going to increase from $1,000 up to $1,500 because she was purchasing the non-IRA annuity for $500 per month. Her monthly maintenance needs allowance is going to remain at $2,178. We determined that she has a shortfall still of $678 per month. She's going to receive some of Roger's monthly income of $3,050 to get her up to the minimum amount of income that she is entitled to at $678. So his copay to the facility is going to be the $3,050 less $678 that shifted over to Nancy to bring her up to the minimum amount of income that she can have, and then also subtracting out the $50 personal needs allowance that he would be entitled to. We determine in this second option that Roger's copay to the facility is $23.22 each month. The economic results of doing the two Medicaid compliant annuities is that the couple was anticipated to pay $10,000 per month. We were able to reduce that down to $23.22. And so the couple experienced a monthly savings of $7,678 per month. The advantages of the second option is that it too is a safe option. Medicaid will accept the converting of the IRA into an IRA Medicaid compliant annuity, where we are naming Roger as the payee of the annuity contract. Roger is still going to be immediately eligible for Medicaid. Nancy has around $21.78 each month in order to meet her monthly needs that she would have. She is going to be the primary beneficiary of Roger's IRA Medicaid compliant annuity. They're going to pay limited federal income taxes on the IRA because Roger is going to receive the 1099 from the insurance company that's showing just a portion of the IRA being considered taxable income as Roger receives the payments from the annuity contract. And their Social Security income in the second scenario is not going to become taxable because we're doing a direct transfer of the IRA into an IRA Medicaid compliant annuity that's owned by Roger. The disadvantages of option number 2 is that if Nancy's income exceeds the monthly maintenance needs allowance, then she's not going to receive any of Roger's monthly income. So the annuity income that's generated from the annuity is going to go to Roger's cost of care, to his patient liability, which is going to increase the amount that the couple is paying towards his cost of care. The third option is to use name on the check rule, where the IRA Medicaid compliant annuity would be owned by the institutionalized person or by Roger, and the payee of the annuity is going to be Nancy. Name on the check rule is strictly a Medicaid concept that basically stands for the premise that the income belongs to the person whose name is on the check. This is not an IRS rule, and it cannot be found anywhere in the IRS rules or regulations. The rule is used in married couple situations when the institutionalized spouse owns a qualified account that must be spent down in order for the institutionalized spouse to gain Medicaid eligibility. The community spouse is named as the payee of the Medicaid applicant's IRA Medicaid compliant annuity. We're basically doing the same type of procedure in option number 2, or in option number 3, excuse me, as we did in option number 2. The only difference is that Nancy would be the irrevocable payee of the IRA Medicaid compliant annuity that's owned by Roger. Roger's IRA Medicaid compliant annuity payment is still going to be $1,050 per month, but instead of Roger receiving the annuity check each month, Nancy is going to be named as the payee. So her name is going to be on the check, hopefully meaning that Medicaid is going to consider that income to belong to Nancy instead of to Roger. The structuring of the annuity is going to be exactly the same as option number 2. other than Nancy is going to be named as the payee of Roger's annuity, Nancy would still have to purchase a second non-qualified annuity that she would be the owner and the payee of in order to spend down the excess resources and avoid commingling pre-tax dollars and after-tax dollars into the same annuity contract. The parties to Roger's IRA Medicaid Compliant Annuity in this third scenario is that Roger is going to be the annuity owner and the annuitant. Nancy is still going to be the primary death beneficiary on the contract, but in this case, she is also going to be the payee of the annuity in addition to the primary death beneficiary. The parties to Nancy's annuity are going to be exactly the same as what we've talked about. She's going to be the owner, annuitant, and payee. In this third scenario, Roger's monthly income is going to remain at $2,000 strictly from his Social Security income in this third scenario, because Nancy is going to be the payee of both annuities. Nancy's monthly income is now going to increase from her Social Security at $1,000 up to $2,550. Her monthly maintenance needs allowance is going to remain at $2,178. In this third example, her income now exceeds her monthly maintenance needs allowance, so she's not going to receive any of Roger's monthly income under the shifting of income rules. And so his copay to the facility is going to be his full $2,000 Social Security less his personal needs allowance at $50 or $1,950 per month. The economic results of the two annuities where we are naming Nancy as the payee of both contracts is that the couple was able to reduce the copay down to $1,950 when they were expected to pay $10,000 per month. So we were able to experience a monthly savings of $8,050 per month. The advantages of option number 3 is that we're able to achieve immediate Medicaid eligibility for Roger. Nancy has more monthly income in this third scenario. She has $2,550 each month in order to meet her needs. She is still going to be the primary beneficiary of Roger's IRA Medicaid Compliant Annuity. They're going to pay limited federal income taxes because we, again, are allowing the insurance company to strictly send a 1099 to Roger on a yearly basis for the amount of income that is being generated off of the IRA Medicaid Compliant Annuity. And so their Social Security income does not become taxable in this third scenario. The disadvantages is that name on the check rule can be a risky strategy. There are an increasing number of state Medicaid departments that are starting to challenge the rule, or they don't count the income to belong to the community spouse. Instead, they're considering that income to belong to the Medicaid applicant, which is going to increase the amount of the Medicaid applicant's copay if they consider that income to belong to the Medicaid applicant. And if the rule is challenged by the state Medicaid office, we really don't have any IRS or tax law to justify naming the spouse as the payee on a qualified account. The map that you're seeing on your screen is showing the states that have been favorable towards name on the check rule. Those states are in orange. The states that are in black are considered to be unfavorable towards name on the check rule. And then the couple of states that are in white have mixed outcomes where sometimes name on the check rule has worked and sometimes it has not. In summary, when you're looking at choosing between option number 2 and option number 3, we really have to consider what the monthly maintenance needs allowance of the community spouse is, because name on the check rule is going to provide an economic advantage when we have a situation where the community spouse's income already exceeds the MIMNA, because they would not receive any of the institutionalized spouse's income if their income exceeds the MIMNA amount. And so option number 2 may still be a better option than just liquidating the IRA if we have a situation where the community spouse's income is less than the MIMNA. They're going to receive that shifting of income from they're going to shift their income over to the community spouse to bring them up to the MIMNA amount anyways. And I know that that was a lot of information very quickly, so I'm happy to answer any questions that people have here. Somebody is asking where they can access a copy of the materials. There is a copy in the handouts portion. If you're on the GoToWebinar dashboard, there should be a handouts portion where I have included a PDF version of the slides that you can download. Otherwise, if you send me your email address, I can shoot a copy over to you through email. Okay, it looks like that is the only question that we have. Okay, well, if nobody has any other questions regarding the material that we went over today, I thank you for being with me today. And if you think of any questions that you want to call or email me about, feel free to reach out either by phone or email with those questions. I hope everybody has a happy Thanksgiving, and we will talk to you in December. Thank you so much.